I'll first start off with one, I think, tip or something that for a lot of existing homeowners could really benefit from. Um, there has been a property tax deferment program applicable to most homeowners over the age of 55 for as long as I've been in the industry, which is about 14 years, and probably past that. And so what that means is that people who have annualized property taxes that they would typically having to pay can move those or basically have those deferred until a later date in which they either pay them all uh, out in one lump sum or could pay them out from the sale proceeds of their home. So it's a good way of for seniors, for example, to look at trying to, I say seniors, they're for 55 age plus, so not necessarily seniors, but basically for people to be able to kind of reduce their monthly cash outflow, especially as property taxes have been rising. More recently, a program has been made applicable to parents with children under the age of 18, where the same program can apply. So they
Mm.
can choose to defer property taxes into the future, at which point they either can pay them out perhaps by refinancing their home later on, selling their property at a later date, or just going back into the deferment or to remove the deferment and start paying them if they chose to do that. Maybe their kids start going to school, they no longer have daycare costs, things like that, where it might make it more flexible for them to be able to pay. So, first and foremost, if you're looking for a good way of trying to reduce some of the outflowing expenses as inflation is continuing to rise, as maybe there's some concerns with overall job stability, first tip that I can throw out there.
Mm.
One way of being able to minimize some of those, outgoing expenses doesn't mean that you don't have to pay it. It is continuing to be there, but in markets like this or with uncertainty in terms of inflation and with, um, cash outflow because mortgage payments have been going up, one consideration to make. If anyone's would like to know a little bit more about the specifics of the program, there are some requirements that you need to follow and guidelines that you need to follow to be able to apply. Happy to connect and kind of walk people through it. And what I wanted to really focus on, and what I find is quite near and dear to a lot of my clients' hearts right now, is, well, one, they're like, what's happening with interest rates and what should I do, or should I make any changes to my current situation to improve that? Right. And I'll talk about that briefly. But more importantly, once we've had that conversation, once they feel clear on what the expectations are moving forward, the conversation almost always switches over to what their real estate goals might be over the next 5 years.
Yeah.
They're starting to feel the pinch of the space that they now have. They've maybe owned their home for a couple of years now, and their family's been expanding and they're looking for a bit more space. And they just, with all the uncertainty that's going on with qualifying and whatnot, they just don't know where to go. And they just don't know where to start. And if this even is a good time. So I thought I could bring some clarity to that, what the best steps are, so that if maybe you're not planning on pulling the trigger and buying something, before the end of this year, but you'd like to be in a place where you could be prepared by Q1 or next spring, where you've done all of the right things to get yourself there.
Yeah. Right.
So, and I think that there'll be some interesting little tidbits, Phil. You might even be like, huh, that's actually a pretty good idea in terms of what existing sellers can use to help better market a property in a declining or like a more balanced market.
Yeah. Sure.
So it always starts off, and when I'm talking with clients, we always start initially talking about what they should be doing with their existing mortgage. I've got clients where they've got variable rate mortgages. I have clients that have existing fixed rate mortgages. Both are still anxious and nervous. Fixed rate clients, their concern is that, well, yeah, it's great that my rate is low now, but in the 3 years that it will take to come up for renewal, what could I expect? What could I be facing? Right, my payment's going to rise dramatically.
Mm.
And so, how I typically walk people through that is, well, let's look at what your payments would look like at that later date.
Right. Yeah.
So, what would be, let's take your existing mortgage now. What would it look like when your mortgage comes up for renewal? Now, we also take it back a step and go, okay, when you first got your mortgage, you had a 25-year amortization, right? The length of time that you'd fully repay your mortgage and what essentially sets your payments. So it's your mortgage principal amount, your interest rate, and your amortization length is what establishes what your payments will be over the next 5 years of your term.
Yeah.
So now they're coming up for maturity, they'll have 20 years left. So we'll look at what would their payments be, assuming they stay with the 20-year amortization.
Right.
And again, assuming that interest rates stay elevated as they are now. And
Yeah.
there's been much discussion as to where rates could be by that time, but they probably expect them to decline at some point. Probably not to as low as they've been in the past, or like over the course of COVID, but certainly lower than where they might be now.
Yeah.
But let's say, for instance, if they're not, they're still elevated. There's nothing that may prevent the client from also re-extending the amortization,
Right.
right?
Right.
So for perhaps they're at 20 years, that's where they're at. But wouldn't it be nice that they could give themselves a little bit of breathing room, improve their overall cash flow, assuming that interest rates are still high, and they could spread it back to 25 years. They could even push it back to 30 years. Now, they're not obligated to have to pay those reduced payments that they've now extended them to. But what they've done is they've established their contractual payment to be as low as possible.
Right. Yeah. Makes sense. Yeah.
So you have, let's say, for instance, a reduction in household income. You have some unexpected expense that pops up in the future.
Yeah.
You can then rescind your increased payment back to your contractual rate and give yourself some space. And
Yeah.
so, and that can apply to variable rate clients, that can apply to fixed rate clients. But I usually start there with people because that's the, oh, I forgot I could do that, or I didn't realize that I could do that. And that's what's going to give me a break. And it's maybe going to give me some of that relief from my anxiety that I'm feeling now, knowing that I'll have that ability to kind of adjust my payments then.
Yeah. So in essence, you're giving them the option to reduce their monthly expense.
Absolutely. Yeah.
Yeah.
So they can pay their mortgage payments as if it's still a 20-year mortgage. Every
Yeah.
lender offers some degree of flexibility to do payment increases.
Yeah.
But what we're doing is we're just giving them a little bit more space that they don't have to make them 20-year. They don't have to keep the payments on track for 20 years. They can
Yeah.
give themselves a little bit of a break.
Yeah. Yeah. That's great information because not the everyday person would potentially know that, and that's why they come to us to be their advisors. That's great.
Absolutely. Yeah.
Yeah.
So invariably I have that conversation with the clients. There's a sense of relief, and then I usually will ask them, well, what are your real estate goals for the next 5 years? Right?
Right.
Some
Yeah.
people, they're just like, honestly, just paying for this home. That's all I really want to do.
Yeah.
Which is totally get that. Other people are like, hey, we're bursting at the seams here. We're expecting another kid. This home was great when we bought it, but now we've got a lot of equity in the home, since we've bought it, but now we're looking to consider transitioning up. And is that the right move?
Yeah.
And so I wanted to go through the steps of what is the right way to prepare, especially in this market, so that they're going to be in the best possible position so that when they feel ready to make a move, they can do it without running into a bunch of obstacles.
Yeah. Great.
So, first off, speak with Phil. Talk to your realtor. He's the best place to start, because he's going to be able to help with us assessing, which is integral to this whole plan. How much could your existing home sell for, and give us an approximation of the timing it would take for it to sell.
Mm.
Right?
Yeah.
Every home is different. Certainly, there's some properties that might sell quicker than others. We also want to make sure that our expectations are grounded in reality. Sometimes people might think that a place that's near them that's currently listed is a good estimate for their home's value, and that may not necessarily be the case. So it usually starts with the realtor to help us establish the baseline and a conservative figure that we need to follow as being our minimum sale price. From there, we go to getting pre-approved. So pre-approval is something that, before you even start considering looking at homes or looking at places and starting to shop around and putting together your list of needs and wants, you need to establish what is the maximum purchase price that not only you can qualify for, but also what you can afford.
Yeah.
So that's been one of the things that, for instance, coming off the heels of the last couple of years where rates have been really good, the concern is now falling back into affordability.
Yeah.
So, what you may qualify for and what you can comfortably pay for could be two varying factors. And that's where a mortgage broker is going to be able to come in there, provide you with here's what you can get from the bank, here's what they're willing to provide to you in terms of qualifying, here's what you could expect in terms of payments based on that amount. And how would that affect you, or how would that impact you in terms of your normal monthly expenses? Is this really going to keep you? Is this going to keep you strapped? Is this
Mm.
going to be something that is going to make you feel uncomfortable, or does this still allow you to kind of carry on with the same lifestyle that you're become accustomed to?
Yeah. Yeah, that's very important. Really important. I mean, so many times, lots of times actually, people call me up and they just haven't even thought of that. That's like the last thing on their mind. They just think they can, you know, go out and start shopping. And, that's one of the first, especially with buyers, just buyers. I get that a lot where, that's something that it's like, oh, yeah, yeah, I'm going to be fine. I'm going to approve, the banks will lend me whatever. And yeah,
Yeah.
not
So
necessarily the case.
yeah, and that comes with one other consideration that we also make too, is that if people are qualifying for mortgage now and their payments happen to be what they're listed as now, if and when we start to see rates being reduced, which most economists expect to happen at some point into 2024, um, they could expect some relief in terms of these payments and costs in the future,
Yeah.
right? As interest rates reduce. So we don't want to necessarily set that expectation, but that is one thing to consider as part of why someone may actually, even in a market where every signal seems to be pointing towards this is not a good time to buy, that you keep hearing in the media, what you keep hearing in terms of interest rates rising, why some people may want to consider it, because the in terms of like rate increases like this that we're seeing as a result of kind of a global economic condition will change. But your home and what you need in terms of like your property for your family to live in, well,
Yeah.
that's a need to have.
Well, yeah, I mean, yeah, absolutely. So, what do you, if you have someone who's like, yeah, I'm just really on the fence because what if I lock in something now and rates start coming down? Where does that put me in, like, 2 years? What do you
Right.
have that question come up?
All the time. Yeah.
Yeah,
So, because again, we provide our observance. So, you can kind of thread the needle on that, right? Well, what
yeah,
if we looked at a 2-year fixed rate, right? What if we looked at a 3-year fixed rate? Something that gave you the comfort of knowing that anytime you hear any further rate announcements in the next 2 to 3 years, you don't have to worry or think about it because it doesn't affect you.
yeah,
And use that as a way of um, having something that's guaranteed for now, and then look to refinance, or when your mortgage comes up for renewal, secure potentially lower rates at that later date.
yeah,
So there's no obligation to have to take a 5-year term. It just, Canadians, for whatever reason, that tends to be the most competitive term product that most lenders seem to market.
right,
Everyone seems to focus on a 5-year period, but there are terms that are 1 year. There's terms that are fully open. There's terms that are 10 years. So
yeah.
it really just comes down to what's the right fit and finding a tailored product that kind of meets your needs.
Sounds good.
So yeah, moving on. So obviously the pre-approval is one thing that we would face. One thing that you might find interesting, Phil, is that there's another thing called a mortgage assumption.
Okay.
You ever heard of that before?
Yeah, I've assumption, and yes, I have. Yeah,
Yeah. So mortgage assumptions, not something that many people even think about, but is often built into most mortgage contracts. And what that means is that another party who might be buying your home
right. Yeah,
could take over your mortgage. So you can imagine if, let's say, you imminently need to sell your home because you need to move up to this next place because it's part of your family requirements, or maybe you're relocating for a job or whatever. And you have a lot of competition in your market for sales, not a lot of buyers, but an increasing supply of listings.
yeah,
Imagine if, in selling your home compared to everybody else's home, you could market the fact that you have, 3-year mortgage rate with, 2.5 at 2.5%, and a
Yeah.
potential buyer taking over that existing mortgage, their payments by contrast to what they've been pre-approved for are 35% less.
Yeah,
So
like it. Yeah, I like that. Yeah, it just takes me back to my licensing training. But yeah, I remember mortgage assumptions. That's a great idea.
yeah, so definitely not something that and this is one of the things that there's always going to be a little bias in this. It's
Hmm.
not something many mortgage brokers necessarily would put out there because, well, there's no change in mortgage amount. So there's
Hmm.
actually no business for a mortgage broker to be able to handle, or get compensated on.
Yeah.
So this is just something that for vendors or sellers that are struggling to sell, that are trying to figure out what are some ways that I can get my property to look better than everybody else's. This is something that gets tag team with the branch. It's something that we assist our clients with as well. So if they're trying to like sell their existing home, but they just want to help, their buyers with transitioning their mortgage. The other benefit of this as well is if the clients don't have another property to port their mortgage over to, which we'll get into in a second,
Yeah.
this also helps them avoid any penalties.
Right.
So bear that in mind. Mortgage assumptions do exist. It's not something that, especially in declining rate environments, that ever really comes up much.
Yeah.
But obviously, when you've got rates that have risen as dramatically as they have, you've got listings that have been sitting on the market for a little bit longer than they normally would. It could be that extra um, marketing tool that
Hmm.
you can use to sell a property.
Yeah. Yeah. That's a really good tip.
Now we'll talk about portability. So you've been pre-approved for your existing mortgage. You know how much you qualify for. You have an existing mortgage on your current place. Um, what can you do with that mortgage? So um, first and foremost, we usually like to find out, well, what are the penalties for breaking it, right? So if we had to break it, and the reason why we also want to know that is um, the bank that you may have your existing mortgage with may not necessarily approve you to buy the next place that fits your needs
Right.
for whatever reason, right?
Yeah.
Because of maybe a change in your job, because they don't like the property, whatever it might be,
Hmm.
they may not necessarily qualify you for it. So we first want to identify, well, what are the potential costs that could be incurred as a result of breaking your mortgage altogether and going with another lender? And is that cost, for instance, by contrast to like another mortgage lender that's out there that's offering really good discounted rates, would it make sense to pay that cost and just start fresh? Um, Now, let's say, for instance, you've got an existing low rate, you want to port it over and transfer it over and take advantage of it for the remaining time that you have left in it, keep your payments down. Um, we would need to work directly with that lender to ensure that you qualify for that same pre-approval amount with them as well, right? So we may come out of the pre-approval process where you're like, okay, my maximum qualification is 700,000 for purchase. My comfort range is 650,000, right? I'm comfortable up to 650,000.
Yeah.
And the existing mortgage that I currently have that I could port over would only let me buy up to 620.
Right.
So with those numbers, if you find that perfect place that ticks every box, maybe it has an extra basement suite to help with cash flow and it's at 700,
Yeah.
you at least know you can achieve it. You just won't be able to get the mortgage ported over.
Right.
And you might be on a monthly basis slightly higher than what you were comfortable with, but
Yeah.
maybe it was something that was worthwhile for you to consider.
Okay. Yeah.
Um, and then, moving backwards from there, obviously, if you can get something at 620 that you can just port your mortgage over for, then that's great too, right? Like you'll be
Yeah.
able to
Yeah.
do that. But those are the three numbers you'd probably want to have in mind as you
Okay.
begin your search.
Right. Yeah. Great info. Yeah.
So now we've talked about the pre-approval. We've talked about your options for your existing mortgage. You need to start reviewing your wants and needs with Phil,
Yeah.
and being able to identify, what are, now that we know kind of the top end of your budget, is that going to get you what you want? Is it more than you need, which is great? Love it when that happens. If
Mm.
it's less than what you need, do we need to go back to the drawing board? And that can come in a variety of different ways. Um, if this is the perfect home for your family and it keeps you close to maybe your parents, for example, and they wanted to support that transition. Maybe we can have that conversation with other family members that may want to provide early inheritances,
Okay.
or potentially increasing your budget by providing a gift, um, or at least just having that discussion.
Right. Yeah.
It's worthwhile to have, because I've run into so many scenarios where I've had clients who have entered into a contract to buy a place that was quite a bit further away than where they want to be, only to find out later from their parents that they're kind of surprised that they didn't ask them for their help, because they would have preferred to do that and keep the family and the grandkids closer to home.
Yeah. Yeah. It's funny sometimes people, money can be such a funny thing.
Yeah.
Mm.
And we talk to parents, we talk to like parents slash grandparents
Yeah.
about this all the time on behalf of clients, because
Right.
they're open to the discussion. I don't want it to come from me because I feel awkward about it, but you can
Right.
maybe just present it in, you know, it's not a forced thing. You don't want to, that they're not obligated to have to do this, but
Yeah.
they should also understand that this is what it would take for us to be here, and whether or not they want to make those changes. And what a lot of parents or grandparents may not know is what type of lending options they may also have that unlocks the equity that they have in their home, that
Right.
could help them with, maybe they were like, oh my God, I didn't know we could get some access to funds here to renovate our home and make it more, to facilitate a better lifestyle for us. Or, like one of them maybe has disabilities. So,
Yeah.
it'd be nice to be able to make the home a little bit more accessible.
Yeah.
So we're totally keen to have those conversations and make sure that everyone, at least everyone, knows what's going on. There's no surprises. No one, there's the expectations are set from the beginning before we put pen to paper and write any contracts.
Yeah. Yeah. That makes total sense.
Yeah. So we've reviewed your needs with your realtor. You're out there on the house hunt. So then the question then becomes, and this is where Phil can probably really help with identifying, given market activity, can you buy something that's subject to the sale of your existing home, or is it something where you'd probably look to sell your home, have it under contract of sale? So
Mm.
basically, there's a commitment from someone to buy your home, so we know the money's coming,
Mm.
and then going out and starting to write offers.
Yeah.
Maybe Phil, you can maybe talk a little bit more about that, and what considerations you would recommend to clients, especially in this market.
Yeah. We see it a lot, and we see offers come in with that, and typically what people will do will just slap a time clause on there. So, you've got the offer, but you have, if someone comes in, and it's happened to me recently. Well, one I've done, and one I know that's just happened with a colleague who they had a stronger buyer who just came in and was able to snatch the property away. So I would always recommend that, however we can, let's have the money available so we can just go shopping.
Yeah.
It is kind of is my ideal recommendation. We can work with subject to sale, and I've done it in the past. And what I do recommend in that instance is have that relationship with the other realtor, or potentially the other two realtors in the chain, and make sure that everything is communication is key in this instance. And but yeah, typically I would always try and say to my clients, have the money, especially in this market in Fernie, because well priced properties are just, they're not lasting long still.
Mm.
It hasn't gone back to the luxury of having the time and being able to set it up. But we can make most things work. That would be my recommendation, though.
Okay, great. So with that in mind, and it's much the same here in Vancouver, for example, like a
Yeah,
subject to sale, by contrast to an offer excluding that clause, is generally less appealing. So
yeah,
what you can do though to still kind of, because like the other side of the coin is that, well, I don't want to sell our home if we are going to be homeless and
yeah,
however long when the transfer of the sale occurs. So there's a couple of other considerations that clients can make for that. So One, and what we would generally recommend is, so yeah, get your home listed, see what the activity is like. So, it would be great. You find somebody who loves your home, has always wanted to live in that area, offers you a fair price for that home, and that you now have put it under contract. What you can do to help yourself is set the contract close date, so the completion date of this contract, to be somewhere between 3 and 4 months into the future. And so, what that allows for is that the buyer of your home can still get their financing, because most lenders will give you an approval up to 120 days.
Yeah.
You can have 3 to 4 months of time to hopefully find the home that you like. So that should hopefully give you enough time to be able to um, start your search and be able to actually write an offer and have it accepted.
Yeah.
Now, when you write the contract of purchase on the new property that you're looking to buy, you can then work with your existing buyer, the one that's buying your own home, and the seller, the home that you're buying,
Mm.
to amend the dates so that it all works out
Right.
if you can. Now,
Yeah.
so for instance, if you can get your sale to complete the day before your purchase completes, that's great. All the money
Mm.
changes hands, the home and possession dates all align so
Mm.
that nobody's homeless or having to move into in with mom and dad for, a period of time while they have to, and move their furniture out and all that while they're making that transition.
Yeah.
So it's the easiest way. Sometimes it doesn't always flesh out like that. Maybe your sale has to complete after your purchase, right? So you actually end up buying a place and you'll technically own two places for, a period of time.
Yeah.
And then your sale completes. And that's okay too. And that's where a term called bridge financing comes
Right.
up.
Yeah.
So the bridge is basically the bank giving you the money you need, which was your down payment coming from your sale proceeds, temporarily to help you facilitate your purchase, and then they'll get repaid with the sale proceeds when your sale completes.
Yeah. Right.
Every bank's different in how they offer it, but most banks do offer it. So again, it's one of those things where if you can get the dates to align, it's great, lower costs overall. But if not, it's still okay. You'd still be able to complete on your purchase. You'll actually have time to move your stuff out. So if, let's say, it can be a bit tough to move as quickly as, generally when you get possession between, the sale of your existing home and the purchase of another one.
Mm.
Um, this can be a great way for some people who just need more time to slowly move their stuff into the new home.
Yeah. Great. Oh, that's it. I mean, there's just always a way to solve the problem.
Yeah,
You just need to talk to the right people,
absolutely.
like me and you.
Yeah. So,
Mm.
really that's all I wanted to mostly cover today was just
Perfect.
the mechanics of moving up. A lot of people, it's on their mind right now. They're not having to buy under the same conditions they would have had to buy in over the last couple of years.
Mm.
Sure, their place maybe not be worth as much as it may have been worth, back in February of 2022 when we kind of peaked at our market.
Yeah.
Um, but that means that the other property that they're looking to buy as well has also probably declined. So
Yeah.
if you're moving up, it's not a bad time to make that consideration.
Yeah. Well, that's it. I mean, the market, that's all it does. It's like when any markets really, they go up and they go down. And, you know, if you want to make real money in real estate, timing it is great. But you just have to work with it when you miss that timing. So, and there are options. There's tons of options out there. If you need to buy, if you need to sell, don't be scared and don't listen to the headlines because you can always make most situations work, in my opinion. Um, and get the good advice of people like myself and Damon here. So Damon, just on that, what's the best way people can get hold of you?
Yeah, so you can call me. You can reach me at 604-607-4704. You can also email me at my first name, Damon, and it's like our website, We Are Pilot, so WEAREPILOT.ca.
Perfect. And what I'll do is put Daniel's wrong person. Damon's contact in the show notes below, wherever this show is being published, so you can easily get hold of him. and ask him any questions you may have, because he's given us some fantastic insight into how to actually make things work in this very peculiar market. I would say right now it's got a lot of people scratching their heads, but and I think it will be the same for the next 12 to 24 months maybe, until we come to a on either a buyer's or a seller's market. But at the moment it's a shifting market for sure. And really appreciate all your insight, Damon. It's been fantastic.
Absolutely. Thanks for having me.
Okay, awesome.